So if you think Trump being in office is going to save you and you're going to have this fantastic growth in all your stock market portfolios and you don't need annuities right now, you got something coming. That's all I got to say. The number one objection I've been getting recently is like, I'm going to wait for the market because Trump's in, it's going to go up another 40% and then we'll come back and do, an income annuity to lock in that guaranteed income for life. Or another one is like, I'll wait for the market to jump up and then I'll contact you for A, B, and C. It's never the case. Like, and I'm going to actually just let David talk to you about it because he kind of looks at the literature. But why do you think that annuity right now might be more important than in 2 or 3 years?
So let's zoom out a second, take the presidents out of it, even though that factors in a little bit. Let's say that his legislation, which he generally uses, is oil and gas, lower taxes for business. Like generally it's going to be lower taxes, a lot of very specific industries that are going to be pushed. Let's just look at the tax side of it and the interest rates to see how it'll affect annuities, retirement, all that type of stuff. Let's say taxes are lowered or they stay low for the next 4 years. Do we know where the national debt is? Last I checked, it was like 36 trillion, right?
Mm-hmm.
Something like that. What happens is if the taxes are still low for the next 4 years or even get lowered, is the national debt going to skyrocket or is it going to go down? So regardless of who's in office, if taxes stay where they're at and they don't start creeping up over the next 4 years, the problem is going to be exponentially worse over the next 4 to 8 years when we actually get there. Because if they stay this low, it's going to be a compounded effect of the national debt. It's going to even get bigger than we were expecting, which again, how do we get down the national debt and how do we fix that? They're going to have to raise taxes or cut government spending, which the biggest line items are Social Security, Medicare. Do we think they're going to cut that? Probably not. Otherwise, I think we're going to have a revolution on our hands. So going back to the whole point, if you think he's going to save your portfolio, he's going to save your taxes, he's going to save your retirement, last I checked, you're still going to be alive when someone else is in office. So who cares about the next 4 years of growth? We need to start thinking about what's the end game. We need to make sure that we are minimizing taxes and minimizing market losses at any point before retirement, not just during a certain 4-year period of who's in office. So that's the first thing I want to touch on, especially when it comes to interest rates. Interest rates are wildly changing. Inflation data is coming back lower than expected, which is good. But what is going to happen is rates are probably, again, because this is the stuff that Trump usually looks at, taxes and interest rates are probably going to start going down. As interest rates go down, what happens to annuity options? What happens to fixed income? A lot of those get hit too. So to your question of like, why would I do an annuity now when I think the market's going to crush it over the next 4 to 6 years? Why don't I just do it then? Well, number one, are interest rates going up or down? Generally, they're probably going to be going down. Are annuity rates and fixed income higher when interest rates are high, or are they lower? They're higher. So why would we not want to lock in interest rates now while it's historically high? That's going to guarantee us a certain amount of income in the future, as opposed to let's roll the dice in the market. Let's roll the dice with interest rates over the next 4 to 6 years. Do we know if the market's going to tank tomorrow? No. Do we ever know when it's going to tank? Did anyone know 2008 was going to happen except for like 3 people? No. Right? So you really think that you're going to outtime the market? That just tells me that you are making emotional decisions with your money, and you've probably bought crypto when it's at an all-time high and then sold it at a 50% loss, right? I work with that because that's a realistic thing. Is everyone gets euphoric when the market's crushing it, and then they're like, oh, it'll come back, and then guess what happens? Then they come back to us 4 to 6 years later of like, man, I lost 30% of my portfolio. Can we protect it now? I'm like, well, yeah, we can, but you're gonna have 30% less income. So my whole point of saying that is we don't ever know when the market's going to shift. If we did know it, you're probably not going to know it because you're a general public person. Like Warren Buffett knows these things. Why do you think they're sitting on so much cash right now? I mean, like 30% of that dude's portfolio or something crazy is cash. He's just waiting. So whenever there's fear in the market, you need to be greedy. Whenever there's greed, which there's a lot of right now, you need to be very fearful and use discernment. So all that I would say is if you're wondering like, you know what, I'm going to put off annuities and put off life insurance, you should never be making emotional financial decisions. If you do, that's exactly why you need an advisor. That's exactly why you need to work with a professional, because simply by having someone who's professionally handling your money and removing your emotions from it, you're going to have a better rate of return. Like even Doug Andrews talks about this. You cannot get a 10% rate of return in the market. Why is that? because you don't have the stomach for it. You need to be buying when it's low, selling when it's high, and that's how you get average of 10. Well, what do most people do? When it's going up, they buy more and more and more, and then when it goes down, they sell. So they average about 3%, 4% average. Net the fees out, they're probably making 3% total, right? So long rant, but what I would really say is no matter what age you are, whether you're like 50, 60, 70, where you're at in the retirement picture, you need to start setting up different things that are guaranteed, that are going to cover the expenses of retirement, where you're not going to have to sweat where the market is. The thing that I always ask people is, what would it be worth to you if you could retire when you wanted to and when you plan to, not when the market told you could? That'd be worth everything, right? Yeah.
Mm-hmm.
No one wants to take chips off the table when the market's high, but that's what you're supposed to do. Is you're supposed to buy low, sell high. Guess what we're at? We're at very historic highs, very historic high inflation rates and interest rates, which is a perfect time to do a lot of these fixed income products, because you could lock in crazy income. I mean, we just did this. You saw the stuff Dan was doing. He just did $10 million of fixed income, which was going to create like $270,000 of income day one. And then 7 years from now, when he turns on the other one, it was going to be like 490,000. I mean, that's insane. So if a lot of people with money are starting to do this stuff, which like this dude had 30 million bucks, do you think that they're probably seeing something that you're not, who have 200, 500,000? So again, quick little rant, but really have a professional review your portfolio and make sure you have protection in place against taxes, inflation, and market losses, because we could get hit with any of those at any time. And if it happens and you're playing reactive, it's going to be too late.
Yep. Yeah, there's a statistic that 4% of money managers beat the market. The market is the S&P 500. So if you have a stomach and you don't sell and you don't emotionally manage your portfolio, you could earn about 9%. So the reason why you can't get 10, like you said, highs and lows, that's it. If you are safe and you are putting your money somewhere where it beats 24 out of 25 of the money managers, that's the best way to go. And then, like you just said, you could probably lock in an 8% income today versus you could get a 5.5 or 6 in a couple of years. So it's like, do you want 25% less income because you waited 2 years? That 2 years would have to double your money basically after tax to get the same income. Mm-hmm. So do you think you can get a 50% rate of return when most people can't get above 9? No. And then again, like with the national debt, just to kind of dumb that down, national debt most of the time, most years on average, goes up 5 trillion and we make 4 trillion. So It goes from 34 to 35 to 36. The reason why it incrementally goes up is there's massive debt. We make almost as like 80% back. And then that's the reason why the debt keeps going up. And if we don't get that debt down, if somehow this 25% tariff that we put out makes us $7 trillion a year, maybe we're out of debt in 20 years. But again, I wish I remember that advisor's name. He's like, I'm a baby boomer, but I also sell life insurance and mutual funds. But if you think that I'm going to not take my Social Security so the taxes can stay low, you're insane. I paid in my whole life to get that. Yep. I will take it, and I will take it not caring about your tax rates.
Yep. Yeah, exactly. And the last thing we'll cover too is you might be thinking, well, like I have bonds, I have stocks, I have bonds, my money's already safe. Do a quick Google search for me. Look up what the average rate of return of like treasury notes, bonds are over a 30-year period. It's about 4.3%, something like that. Also Google what they did in 2008, because people forget that bonds are a market. There's a stock market and there's a bond market. So if people don't want to be buying your bonds, guess what? You're losing money. The answer to the what bonds did in 08 is they did negative 20%. So again, if you're trying to be safe with an asset, you can get way higher rates of return, way better average rates of return with basically zero risk, instead of risking a 20% downturn on the money that you're trying to be safe with.